Hi, this is Chris White, the CEO of BondCliQ. I'm going to take you through a recent address I delivered at the Future of Market Technology conference that was hosted by Anonymous Research, which is a division of AllianceBernstein. This content is going to help articulate the link between transparency and market liquidity. Now, before we start talking about solutions for the US corporate bond market, it's really important that we have a collaborative view of how we want the market to work in the future. Now, for any institutional market, I think we could all agree that the vision of the future or the ideal vision of the future looks something like this. Based on the examples of other markets and available technology, we don't have to compromise on this vision. We can make it a reality in the US corporate bond market. Now, it's a different world, but we have the same problem. Since 2008, the US corporate bond market has gone through a profound change. The two main areas of transformation have been in size and in risk. It's quite easy to see now that the market is bigger and riskier than ever before, but institutional liquidity still remains elusive. We've heard the persistent concerns about liquidity. It's been going on for years. And the thing we must acknowledge as a marketplace is that the institutional corporate bond market floats on a set of pricing data that is fragmented, incomplete, non-standard, and stale. Now, this problem in terms of institutional liquidity availability is a problem that actually has a pretty extensive history because 50 years ago, US equity markets were experiencing massive growth. And despite this increase in the overall size of the market, they were having institutional liquidity issues as well. Now, at this point in US equity market history, their market data was completely disorganized and of poor quality. If you want any information on this or an example, you can just look up the history of the crash of 1962, in which just available pricing information was so hard to come by that the market whipsawed for solid 3 days in a row. Now, a historical problem needs a historically proven solution. So the question you have to ask yourself is, how did they fix this in the US equity market? Well, the genesis of the resolution was in 1971 when the first consolidated quote system was launched. Now, we recognize NASDAQ today as being an exchange, a place to trade, but its initial formation, NASDAQ, stands for National Association Securities Dealers Automated Quotation System. What a consolidated quote system really is it's a non-executable bulletin board of dealer quotes with real-time bids and offers organized into a montage, and the quotes have attribution with size details. Now, this simple piece of architecture was so effective at improving the unlisted market volume for US equities that the SEC recommended that listed markets adapt a similar piece of architecture, which they did in 1975. The consolidated quote system that was introduced into the New York Stock Exchange profoundly changed the rate of turnover in the market. Now, one thing to recognize here is this was done without electronic trading or algorithms or any of the things that we think about when we think of equity modernization. Equity markets got better with more trading and more liquidity simply by organizing their data. Now, how do we know that consolidated quote systems are essential architecture for market evolution? Well, there's a historical record. Each one of these is an example of a consolidated quote system being introduced into a major financial market. And what we've seen out of these financial markets after the introduction of consolidated quotes has been the growth in modern tools and products across the market. Now, none of the things I've listed predate the consolidation of quotes. For example, you really can't have a futures market, a robust futures market, without having price centralization, because how are you going to be able to trade the future if you don't know how to trade the cash component underneath? But all of these advancements together create an environment with comprehensive and sustainable market liquidity. The link between transparency and liquidity is clear. You have to look at some behavioral economic texts to see it. But it first starts with the fact that in any market, lack of basic data creates ambiguity. I think we can all agree on that. Then, as that market becomes larger and more complex, the ambiguity levels increase and they trigger something that behavioral economists call ambiguity aversion. Now, the definition of ambiguity aversion is the behavioral tendency that human beings have to prefer known risks over unknown risks. To break this down a bit more clearly, we're seeing this happen in the institutional corporate bond market today. We know that even though there's been growth in volume, it's being generated by fewer and fewer bonds. We also see the data about block trading per bond over time. And what we see is that comparing activity from 2006 to 2015, older bonds have less block trading activity. This is despite the fact that the market is much bigger. All of these things point to the behaviors when the environment has a high degree of ambiguity aversion, because market participants are trading in the instruments that they actively have information in, where they can measure the risks. Those are pretty much the most actively traded bonds. So any bonds outside of that bubble are not getting any attention and are not trading frequently. So what is BondCliQ? We'd like to call ourselves the SIP for the corporate bond market, but we're effectively a data as a service business for corporate bonds, not a trading platform. And what we do is we gather, organize, and distribute high quality institutional US corporate bond data. This is done in real time, or we can give you historical information that covers transaction data and pricing from our consolidated quote system. And the way that we get the data out to the market is through our data visualization application, or direct API feeds, or end of day flat files. But what we've done in the last year has been to launch the industry's first consolidated quote system for US corporate bonds. Now, our consolidated quote system is unique from any other pre-trade product in the market. Here are the areas that we differentiate ourselves. We're the only system where dealers can see the institutional market. And this allows market makers to position their markets properly throughout the day. They can cancel, they can update, they can change their prices, they can refresh their markets. They're not able to do this with any of the other systems that are out there that are gathering pre-trade data. So by allowing dealers to see, this starts to reduce stale and inaccurate quote information in the market. Taking a step further, pricing data is centralized, and no other system out there does this, but for all buy-side market participants, they're going to see the same pricing information at the same time through the BondCliQ system. And what this does is it eliminates fragmentation and creates the true market, the objectively determined market. And then finally, we have a proprietary ranking system. Market makers are ranked according to the quality and consistency of their prices that we receive. This makes dealers compete for order flow based on customer service, based on their pricing proficiency. The better they quote, the more order flow they get, the more they'll improve their quotes. In the end, it creates an environment in which the pricing information for the institutional market starts to improve over time. So what's our expected impact on institutional markets? There are many initiatives that have come and gone over the past 10 to 15 years that have promised that they're going to fix or repair this broken US corporate bond market, but they've been light on the details. This is how we think it works through BondCliQ. By first giving dealers access to institutional pricing data, it will trigger an effect that will result in reliable and accurate pricing with consistent liquidity and limited information leakage in the institutional market. Because once you give dealers access to their own institutional pricing data, They can improve the quality of the overall institutional data by updating their markets and being able to properly position their prices. That then attracts more buy side client order flow because here I'm starting to see real information. And when I follow up with dealers on it, they're actually there to trade. And it also improves on the dealer side their risk management capabilities because they know where they are in the stack and they can make informed decisions when engaging customers. Further on the buy side, having access to high quality data and the way that we are organizing it improves their ability to select the right dealer for their first phone call when doing a block trade. That dealer selection process is critical to getting the best price in the marketplace without having the market move against you. In addition, the order flow coming from the buy side starts to accelerate the ability for dealers to turn over their inventory, which is critical. Now, on the sell side, having access to higher quality institutional data that helps them manage risk will encourage more sell side dealers to produce or to publish live executable markets into the marketplace. Also, the improved risk management on the dealer side, combined with the accelerated inventory turnover, improves the overall ability for a dealer to take risk. Improvement in that area will attract more risk taking dealers and will expand the scope of bonds that can trade. This is how we get to the institutional market that we're all looking for. So there are some frequently asked questions about BondCliQ. Why are dealers voluntarily providing institutional quotes to BondCliQ? Well, we have an incentive package for dealers that's not only monetary, but it's also strategic. We also, through our system, give dealers the ability to access information without giving away their proprietary data to their competitors. So those protocols are what makes this an acceptable solution to institutional dealers. Don't prices have to be executable on screen to be high quality? No. Prices being high quality are prices that are reliable for trading. They don't necessarily have to be click to trade prices. In order for prices to become more reliable, the dealers first have to see the quoted market and see the context of their market. Every single major market that has live executable pricing in a meaningful way first started by organizing their non-executable quotes onto a single screen. Do you need all dealers to participate to create quality data? Absolutely not. Right now, we have over 35 dealers that are contributing data to us. And what we're seeing from our quote data is not only is it accurate for where bonds are trading in size, but the quotes that we have cover 90% of the trading volume in the marketplace. Has this been tried before? Um, Absolutely not. No one's ever tried quote consolidation in the U.S. corporate bond market. And then finally, how is this different than what some large clients are doing on their own? There are definitely some clients that years ago started aggregating data and certainly have a leg up in terms of being able to see the pre-trade market over everyone else who's out there. But what's different about BondCliQ is we can answer a question that those initiatives can't answer, which is how does the quality of data improve over time? Because a large customer creating a micro network of their own aggregated pre-trade data is great for them, but it doesn't actually contribute to the improvement in the reliability and the accuracy of that data because dealers can't see. With our system, not only can dealers see where they are, they can compete for order flow through our system, and they're ranked according to how well they maintain quotes. All of those things will eventually produce pricing data that is pre-cleansed due to the competitive environment. Finally, if you want more information about BondCliQ, you can go to our website, www.bondcliq.com. We also have a monthly blog called The Inside Market that you can access there, plus our intermittent research called the Institutional Market Monitor. We have trials for any of our products available. All you have to do is email us at info@bondcliq.com. And finally, if you have any questions for me, I'm happy to take your emails directly and I'll respond to you. Thank you for taking the time and listening to the address that we gave at the Future of Market Technology Conference. Hope to be hearing from you soon.